Variable costs as a percentage of sales for Lemon Inc. are 80% of current sales. Sorry. Current sales are 600,000. Let me do this. Okay. So variable cost as a percent of sales is 80%. So for every dollar that I sell, I spend 80 cents to create that dollar. So what does that tell me? That tells me that my contribution margin is 20%. That contribution margin is what contributes to cover fixed costs and to increase operating income, right? So current sales is 600,000 and fixed costs are 130,000. How much will operating income change if sales increase by 40,000? I don't even need this information here. I don't need the current sales or the fixed costs. Why? Because I already know that my contribution margin is 20% of whatever I sell, right? Because it says it here. Whatever you sell, X, let's put it this way. Sales, if sales is let's just, to give you a number, if sales is 100, and I want to make this in, okay, if sales is $100, let's make this in dollars, okay? And it says that my variable cost is 80%. That means that my variable cost in this example will be 80, right? So what's my contribution margin for every unit that I sell? My contribution margin to cover my fixed costs is going to be equal to 20, right? Which is 20% of sales. Okay? And this is this should be, okay, 20% of sales. So for every dollar that I sell, I contribute $20. I'm sorry, for every $100 that I sell, I contribute $20 towards the bottom line. First, it's used to cover my fixed costs, and then after I cover my fixed costs, it helps increase my operating margin, right? So if I sold $40,000 more, that means that 20% of that is going to go towards increasing my bottom line. The rest is variable cost, right? And so my income is going to increase by 8,000. That's going to be, answer is going to be A. If you look over here, you can see that I prepared it to confirm it. Sales was 600,000. If sales is 600,000 and says variable cost, see, I combined these two. Let me take this out because this could be more confusing let me take that out for now. Okay, let's just do this all over again with the 600,000 and the 640. Okay, so if sales was 600,000, my variable costs are 80%, right? So my variable cost is going to be 80% of sales, which means that my variable cost is going to be equal to 80% of this. That means that my contribution margin was how much? Well, my contribution margin is this minus this, which is 120, and I could tell you right now that's going to be 20% of 600,000. Okay, so I'm going to get 20% here because that's just the way it's always going to work out. Okay, this is a percent of sales and this is a percent of sales, so they both have to combine to 100% because sales is 100%. Okay, so that's my contribution margin. Okay, so that contributes towards fixed costs, right? So my fixed costs are, it says fixed costs are 130,000. Okay, that's my fixed cost. So what's my operating income? My operating income is going to be, I'll just call it OI to make our lives easier. My operating income is going to be the 120 contribution margin minus the 130, which is not good because I have a negative 10, right? But anyways, so I increased sales by $40,000. So this is my operating income is going to benefit by $8,000. In other words, my operating income won't increase, but my operating loss will decrease, which is pretty much the same effect. I have an increase. I have a decrease in the loss, which is an increase in operating income. That's how the question is being phrased. I wish this would have been positive so that you won't be confused, but unfortunately that's not the case. Okay, so if let's say I copy paste this. Let's paste it here. And you'll see how this is going to become a negative 2. It's going to benefit by $8,000, which means operating income increases by $8,000, right? So if I come over here and I go 640, 1, 2, 3, that means that my variable cost is going to be 512. My contribution margin is 128. Notice how contribution margin increases by $8,000, and now I've benefited by $2,000 in my operating income. Okay, so the answer is A, $8,000 increase in operating income. Okay, so that's the answer to that one. Let's go to the next problem. The next problem says, if fixed costs are $450,000, the unit selling price is $75, and the unit variable cost is $50. What are the old and new break-even sales in units if the unit selling price increased by $10? Okay, so we'll do two columns, right? Fixed costs stay the same at $450,000. Okay, under this scenario, I sell the product at $75. Okay, and the variable cost will stay fixed at $50. So the contribution margin is going to be $25 per unit sold, right? So if I have to sell 18,000 units to break even, how do I come up with that 18,000 units? Well, if each unit contributes $25 to cover fixed costs, how much units do I have to sell? Take the 450 divided by 25, that's 18,000 units. Now, if I sell it for $10 extra, I will have to sell less units, right? Because I sell it for $85. Variable cost stays the same, so now it's contributing $35 per unit. So how much do I have to sell? Well, take the 450 of fixed costs, which doesn't change, divided by $35 contribution margin per unit is $12,857. Now you may say, well, okay, so it's logical. Since the break-even point is lower here, why don't you obviously should sell it for $85 per unit, right? Because it gives you a higher contribution margin. But remember one thing. If you sell by $85 per unit, less people will be willing to buy it, right? Because it has a higher price. So then the question becomes, are you going to be able to sell more than 12,857 units? In other words, is the increase in sale worth it for you? Because if the price causes the the demand to decline so much, it might be actually harder to reach this break-even point under this scenario than under this scenario, right? Because this has a higher price. But anyways, that's not the question that was asked. The question that was asked was, what were the two break-even points? Well, the two break-even points are 18,000 and 12,857. So the answer to that one would be answer C. Okay, let's go to the next question. Okay, this question here is about product cost and period cost. And so you're going to have to, for this test, please memorize all of this. This will tell you what are the product costs. This will tell you the period costs. Product costs are divided into direct, indirect, direct or raw materials, direct labor, factory or manufacturing overhead. It tells you which ones are variable, which ones are fixed. Learn this because it's going to be very useful for the test, okay? So, the question on this one is, I'll give you something like this, and you need to identify the product cost and the period cost. I have the answers here, but let's do it here on the side to see if we get it right again. Okay, so let's start identifying product costs. Is direct materials use a product cost? Yes. Is depreciation on factory equipment a product cost? Yes, it is. If it would have said depreciation on administrative office, no. But because it says factory equipment, yes. Any depreciation on factory equipment or anything having to do with the factory is a product cost. Indirect labor would be like a production supervisor. That is absolutely a product cost. Direct labor is the people that put the products together, so that's a product cost. Factory rent is a product cost. If it would have said corporate headquarters rent, no. But it says factory rent, so it is a product cost. They all fall under the manufacturing overhead category. At least this factory rent does. Factory utilities, that's another manufacturing overhead category, yes. And last, but salaries, sales salaries expense, no, that's a period cost. Office salaries expense, that's another period cost. Indirect materials, these are things like glue if you're producing a product. Miscellaneous things, sanding paper and things that you might need. Absolutely a product cost. So the answer to that is yes. So the product costs identified were these were all product costs. So what are the period costs? This is a period cost and this is a period cost, right? Does it add up to what we have there? Yes, right? So these are the period costs. Is this a product or a period cost? It's sales, it's a revenue, it's not a cost, okay? So don't get fooled by it. Just because it's here doesn't mean that you have to include it. That is absolutely not a cost, that's a revenue. Do not include it. Once again, I'm going to stress, learn this chart. Learn this chart because it's going to be very important for the test. Okay, so let's go on to the next problem. Okay, so let's go to the next problem. And I've left the answers here because it'll just make it easier for us. Okay, in this problem, let's see what this problem is about. It says Falcon Company produces a single product. Its normal selling price is $25 per unit. The variable costs are $14 per unit. Okay, so it produces a product for $25 per unit, variable cost of $14. That means that you know that the contribution per product is $11 per unit. Okay, so right here I'm already setting this up. None of this is given to you. This is we're trying to solve the problem. Okay. Fixed costs are $20,000 for a normal production run of 5,000 units. So my fixed cost is $20,000. Okay. And I produce for 5,000 units produced. I don't know what that means. It might not be necessary since I don't have it down here. Okay. It says Falcon received a request for a special order that would not interfere with normal sales. Okay, so now you have an ability to do a special one-time order. It's not going to hurt your normal sales, so you don't have to worry about about whether giving a special price for this customer is going to affect these other sales. If it does, then that's a totally different analysis. But it's telling us that it does not affect normal sales. Okay, so the order is for 1,250 units with a special price of $18. Okay, so it has a special price. You're going to sell it for less than the $25 that you sell the your normal units. Falcon has the capacity to handle the special order. So this is a hint. When it says Falcon has the capacity to handle the special order, and for this order a variable selling cost of $1 per unit will be eliminated. Okay, so it's a hint. It's telling you that we have the capacity. Falcon has the capacity. In other words, your fixed costs are not going to go up. You do not have to add any more equipment or anything like that. You're just simply going to take advantage of idle time. Okay, so do I want to do this? Well, the first question is, if I sell this at $18 per unit, is that going to upset my regular customers, the ones that pay $25 per unit? And if the answer is no, if they have no way of finding out, then we start doing the analysis. Okay, and it says here that it would not interfere with normal sales. Okay, so it's not going to upset them. Okay, so if I take the special 1,250 unit order and I sell it for $18, okay, I know that my variable cost was $14, but it tells me that my variable selling cost for this one, I'm going to have $1 less. Maybe because I don't have to pay $1 in commission to the salesperson. Perhaps this customer came to the company directly or something like that. So my variable cost is going to be $1 less, right? So each of these units is going to contribute $5 per unit. Notice how they contribute a lot less than your normal sales, which is $11. However, would you rather get $5 for an extra 1,250 units or zero? I would rather get $5, right? As long as it does not interfere with the production for my other higher margin sales, my normal sales, and as long as my other customers don't find out and get upset with me and I lose business because of it. And I'm simply taking advantage of idle time that I have. My equipment is sitting there doing nothing. So I rather take this special order. Absolutely, I'm going to take it. I'm going to earn a little less per order, but it's better than earning nothing. And so if I get $5 per unit and I sell 1,250 units, my bottom line will increase by $6,250. So the answer to that question is yes, absolutely accept. There's some conditions for this, right? First of all, your existing customers can't find out about it, or if they do, they won't be upset and they won't leave you. Second of all, you are simply taking advantage of idle capacity. So you're not going to have to buy new equipment. You don't have to increase your fixed costs. You're simply taking advantage of downtime that you had before. And so in that case, the answer is yes, proceed with the 1,250 special pricing, because you're going to get $6,250 more to your bottom line. Okay, let's go to the next problem. It says Sage Company is operating at 90% capacity. Okay, so this is a company, another one that has more capacity, and is currently purchasing a part used in its manufacturing operations for $20 per unit. So the purchase price is $20 per unit. The unit cost for the business to make the part is $25. So it's going to cost them $25 in total. But that includes fixed costs, right? This is fixed costs that we are already incurring. So it's a little deceiving. It's a little misleading. that fixed cost is not going to go away if we don't make the part. Okay, so what's the incremental cost of making the part? It says, and $13 not including fixed costs. So really the incremental cost is going to be $13, right? Total cost is $25, but of the $25, $12 is fixed, meaning that that $12, if you don't make the part, you're gonna incur it anyways. You're gonna have to allocate it to another product or something like that, right? That's just a cost that's allocated. The true incremental cost is $13 per unit. Okay, so I can see that my incremental cost to make it is 13 versus a purchase price of 20. Obviously I'm gonna make it, right? But let's continue with the question. If 30,000 units of the part are normally purchased during the year but could be manufactured using unused capacity. Okay, that's the key. It's unused capacity. So this is $12 is the 10% that you're not using. But you're gonna spend it anyways. You have to pay for it anyways, right? So it should not affect your decision. It's what we call sunk costs. It should not affect your decision. If 30,000 of the units are normally purchased during the year but could be manufactured, what would be the amount of differential cost increase or decrease for making the part rather than purchasing it? Well, I could see that my incremental cost is only $13, right? Because I'm not going to include the fixed cost. If I purchase it, it's going to be 20 times 30. It's going to be $600,000. But if I make it, it's going to be 13 times 30, 390. It's going to be cheaper for me to make it than to purchase it, because my differential cost is going to decrease by $210,000. Okay. So the key here is to understand why we don't include fixed costs. Okay, fixed costs is cost that's already there. If you don't allocate it to this product, you're gonna allocate it to another product anyways. That doesn't go away. So you do not take fixed costs into account when you make this decision. Okay, let's do the next problem. This problem has to do whether you want to eliminate a section or not. And again, fixed costs are going to play an important role because fixed costs do not go away. So let's take a look at this problem. It says the condensed income statement for Flesher is as follows. You could look at this as a product or as a segment. It doesn't really matter, okay? I think your book calls them segments. It could be a segment or it could be a product. The analysis is exactly the same, okay? So they show you this and they say, okay, management is considering discontinuance of product G. As you can see, product G has a negative bottom line income loss of $25,000. And if you look at this in isolation, you would say, yes, it's better to take out product G because you're losing $25,000 on it, right? But that would be wrong because product G is carrying $40,000 of fixed costs. If you get rid of product G, this fixed cost is not going to go away. It's going to have to be carried by either F or H, or maybe split in the two. So it's not going to go away, right? So management is considering the discontinuance of product G at the beginning of the current year. The discontinuance will have no effect on total fixed costs, okay? So total fixed cost is going to stay the same. Or on the sales and expenses of product F or H. And these numbers are not going to change, okay? So they're going to stay the same. The only thing that's going to happen is if you get rid of product G is that now all of a sudden $40,000 in fixed costs must be carried by these two, okay? What is the amount of the change in net income for the current year that will result if you get rid of product G? Okay, so this is my total under this scenario, right? So let's see what happens if I get rid of product G. 75 minus 175 in revenues. I'll have 550 in revenues, right? It's this one plus this one. I got rid of this one. 560 minus 160, I have 400,000 in variable cost, which is this plus this. I got rid of that variable cost because variable cost will go away with the product. Unfortunately, in this category, you can't get rid of this. This is a fixed cost. So now, it's things like rent and so forth and so on. So you can't get rid of it. So it must be carried by these two. So fixed costs stay the same. So my total cost is going to be 530 and my bottom line is going to be 20,000. Should I proceed? No, I shouldn't proceed because I'm going to have a decline from 35 to 20. Okay? Why did that happen? Because product G was helping me absorb some of this fixed cost. Product G was actually helping a little. It was actually lowering these fixed costs from 40 down to 25. Okay? With the sales. So if I get rid of product G, I end up worse off. So the answer, if the question was, should you keep product G or segment G? The answer is yes, because if you don't, your net income will decline by $15,000. Okay? Let's go to the next question, the last one. Okay? And if I'm correct, I've reviewed maybe as much as 16, almost 1/3 of the whole exam in these problems, okay, alone. The last one has to do with allocation of scarce resources, okay? It says, Payton Company manufactures phone X and phone Y. Payton can sell it, all it can make of either. So I could sell 100% of X or I could sell 100% of Y. Based on the following data, if the sales price is 45 for X and 34 for Y, and the variable cost is 38 for X and 22 for Y, if we look at it this way, let me do an insert here, right? If I look at it this way, I say, okay, X gives me a profit margin of $7 per unit, and Y gives me a profit margin of $12 per unit. So which one should I produce? Y, right? I should produce Y. But you're missing a part of the formula. And a part of the formula is how many hours it takes to produce each one. Notice, it's going to take more hours for me to produce Y than it does to produce X. So I must incorporate that factor in my decision. Okay, so what I'm going to do is I'm going to calculate a profit margin per hour. Okay, let me take this out, delete, a profit margin per hour. Okay, now I got this wrong, right? So if I make $7 per each unit, but each unit takes 5 hours to produce, I have a profit margin of $1.40 per hour that I invest. Whereas over here, I have a profit margin of $1.33. All of this in our decision changes, right? Because we only have a certain amount of hours in the day to invest. So we have to maximize our usage of those hours, right? I would rather spend my time on product X. It has a lower margin per unit, but it takes me a lot less time to produce. And time, as they say, is money, right? I could earn $1.40 per hour producing product X, whereas I only earn $1.33 per hour producing product Y, okay? So I would choose product X in this case. And the lesson to be learned here is do not look at contribution margin in isolation. You have contribution margin per unit is important, but you also must incorporate in your decision how long does it take to produce each of those units, okay? And of course you have to incorporate the fact that you can sell it all or not. In this case it says that you can sell it all, so you don't have to worry about that component. So those are all the problems for exam 4. I hope this helps. Like as usual, also study the concepts in the review sheet that I have on Blackboard, and we'll go through these problems in class. Thank you.